Good afternoon and welcome to the CNBC-TV18's Mumbai newsroom. I'm Sonal Bhutra and with me is Pavitra Parekh and you're watching Mutual Fund Corner. Well, Pavitra, good afternoon. A budget is out of the way, but of course a lot of announcements were made. But actually for mutual fund industry, so to say, there were not any specific announcement. But other announcements do have an indirect impact on how the flows will be, how the demand will be. So let's get started and talk about what is the impact of budget announcements on the mutual fund industry.
Absolutely. I think it's, completely top of mind. People would want to know how this really impacts mutual funds. So we have an expert joining us to really take us through what all of these announcements mean for the mutual fund space. We have Vishal Agarwal, who's partner of tax at Thornton, who's joining us. Vishal, thanks a lot for joining us and taking out the time to, speak with us today. Like Sonal was mentioning, we saw a whole slew of announcements come through on the tax front, on market-linked debentures. Your first thoughts on these, and how do you really think this impacts the entire mutual fund industry?
Right. Thanks, Pavitra, and thanks for inviting me to the show. Like you mentioned, there is nothing directly in the budget for mutual funds. I think we're entering a regime where going forward, you're not likely to see specific incentives. What you're really seeing is the government focusing on a simpler tax regime. But there are a whole bunch of other announcements that have been made, which will give guidance to investors and mutual funds on which way economy is growing and what will impact them as the industry and as investors. So growth is a big, they're looking at growth in a big way, a lot of CapEx. They're looking at sectors, there's infra, information technology, and education. These are clear guidance points on where CapEx is going and investments is growing and where they expect to grow. So while a lot has been said on the economic development front, there are also elements of regulatory changes that seem to be in the offing. There's a whole review of the regulations that the regulators are going to undertake. This forms a big occasion for mutual funds to go ahead and iron out some of the challenges that may have been there and find a way to align different products across different regulators and make them sharper to help innovation overall. Also, the KYC reform that has been announced, where a single investor will make some filings and that can be used across the spectrum. That is a big positive, and that makes it far easier for people who are looking to invest. And it's a big pain to go and do the same filings with different people at different times. Also, while there's no direct thing on the fiscal side, on the tax side, there are a bunch of announcements which impact the mutual fund investors directly or indirectly, or even mutual funds. Look at the exemptions that have been taken away, the 80CCC that we talk about. So mutual funds, flows into mutual funds will get impacted, but equally flows into insurance products will get impacted. And therefore, the two of them could offset each other. If you're looking at mutual funds as pure investment products, maybe they get a larger share of that flow. And also, I think you also mentioned MLDs. That's a very important development. It was a product that was making certain types of investments more efficient in the debenture segment. With that getting plugged, meaning that is going to suffer a higher rate of tax, maybe a bunch of investors who were looking at that previously could start looking at mutual funds as well. So it's an interesting set of announcements with some guidance on which way things are likely to move for the industry.
When you talk about guidance, Vishal, that's exactly my next question, because there is a definite focus on the new tax regime, which means that deductions under ATC won't be available. What does it mean for mutual fund schemes like ELSS? Do you think their attractiveness will decline? And this is something that the government will focus on as well, the new tax regime. So how will that impact the mutual fund industry as a whole?
See, I think for now, given that the old regime exists and there is this whole comparison going about on, if you're at a certain salary level, whether the old regime is good or the new regime is good, I think that directionally the government is very clear that they are going to keep making the old regime redundant. The tax incentives linked to investment products will probably keep declining. Similarly, the new regime will keep getting more interest and becoming more attractive. So I think we can safely assume that any investment that was driven with the objective of reducing your overall tax burden at the offset, those may keep going down. So it will, in the near term, very near term, impact flows that go into these schemes purely for tax benefits. And you will see people evaluating these schemes a lot more from just what they should be. Are they good investment products or not?
No, that makes complete sense, right? Why would someone not just go and invest straight up in a multi-cap, flexi-cap kind of fund instead of
Absolutely.
an ELSS fund. But since we are talking about ELSS, I want to ask you about the debt-linked savings schemes, because this has been a long pending request of the industry, right? Do you think now with this thrust towards the new tax regime, it just becomes pointless and that's just not going to happen?
Yes. So again, if you're going to move away from investment-linked incentives, either to individuals or to corporates or anybody, launching a scheme which will sort of find an origin in a tax benefit may not happen, because I guess those tax benefits are not likely to come through. Now, and hence DLSS, if it was on the basis of ELSS, may not make any sense anymore. And I think increasingly the direction is very clear that they want to do away with all of these kind of investments, investment-linked benefits. So I would imagine that the way the industry ought to move on DLSS is find a way in which debt investments are channeled, and the origin of these being in an investment-linked incentive, that's unlikely to be a driver for any of these products.
Okay. While we are talking about no capital gains tax tinkering that happened in this budget, and the markets are very happy about it, but there was a long list that came from mutual fund investors, at least, that, it should be rationalized more when it comes to capital gains tax. What, according to you, could be done more in terms of changes in tax structure for mutual fund industry, which is something that needs to be done now?
So again, good question. I think there are, and we also believe that not tinkering with the tax regime too much is a great positive. It maintains stability. There was, yes, there is a case to rationalize it. It is very complicated. Different instruments have different tenures and tax rates, but a lot more thought needs to go into how that is to be equalized. For mutual funds themselves, now there has to be firstly parity between mutual fund investments, at the minimum, mutual fund investments and direct investments in underlying securities. So we have, so for in the debt space, mutual fund units, debt mutual funds have certain disadvantages compared with investing directly in ventures. On the equity space, they seem to be more or less equal. But if you switch from one mutual fund to another mutual fund, you end up suffering, mutual fund scheme, you end up suffering some tax. So these are small things that need to be ironed out. At the minimum, you should be equal between mutual funds and underlying investments. Switching of mutual funds has to be more seamless. But more importantly, I think this is a good time to rethink how you want to tax such investment products, right? Because they are widely distributed. They are raising a lot of capital. They should be ideally better placed on the tax front than direct investments, because they are savings products and investment products, professionally managed, and hence need to have some kind of incentive over going direct. And at the minimum, things like switching of mutual fund schemes, that should really not be subject to tax. So there is a need to rethink, like we are thinking the regulations, also to rethink how we want to tax mutual funds category as a whole.
Oh, absolutely. This has been the top request from everybody that we've spoken to, from the industry. But Vishal, on that note, we're going to wrap up this chat. Thank you very much for joining us and taking out the time to speak on this very important, on all of the announcements that came through from the budget. We do have to take a short break now. But on the other side, we're going to do a deep dive into ELSS funds and tell you if they really do make sense under the new tax regime, because the government is pushing so hard for that. Mohit Gang will join us. We'll have that chat after this short break. Hey guys, welcome back. You're still tuned into Mutual Fund Corner here on CNBC-TV18. We've been talking about all of the budget announcements that came through and how they can really impact the mutual fund industry. So we have another guest joining us. Mohit Gang joins us. He's co-founder and CEO at Moneyfront. Mohit, thanks a lot for joining us today. Like we were just talking about in the previous segment as well, there have been a lot of announcements that came through which may not directly impact the mutual fund industry, but there is a lot in the fine print, right? So your first take on the announcements that came through?
Hi, Pavitra and Sonal. Always a pleasure to be on your show. So look, there is nothing which directly impacts or benefits the mutual fund industry per se, but indirectly, I think there are a number of provisions which kind of boost up the entire mutual fund industry. The first one, though it's open for debate as to how much impact it will have on the mutual fund industry, but gradually the benefits under Section 80C will get phased out if more and more people opt for the new tax regime. The largest impact to my mind out there will be the insurance industry, right? So more people moving out their financial savings from insurance will mean more people moving it to other simpler financial assets, and mutual fund will be a direct beneficiary out there. So mutual fund will also lose out some pie of ELSS money, but my sense is that will get moved into other formats of mutual fund scheme. The clause on high value premium policies above 5 lakh now getting completely taxed as per your marginal tax rate. That's a big blow to the insurance industry. And I think that chunky money will now start incrementally moving to mutual fund as an industry. And that I think will be the biggest benefit for the industry.
Okay.
Again, I think you were discussing in your previous show, MLDs, which to my mind have been a tax arbitrage instrument for last 15, 16 years that I've seen, have been rightfully so plugged in and checked. And I think those instruments and that kind of money will either move towards bonds or deposits, or will now come into debt mutual funds. So again, I think mutual fund becomes direct beneficiary out here. Few other schemes, few other points. I think, let's say LRS having a 20% TCS. Again, indirectly, to my mind, money which was moving abroad for investments can be checked on a little, and that flow could, to some bit, get diverted into mutual funds. Right. So these are, and again, one more point being the high value properties which will get taxed above 10 crore of price. There was a lot of tax arbitrage why this money was moving into properties to save on long-term capital gains taxes. And that money also is now likely to move into financial instruments to a large extent. Again, mutual funds could be an indirect beneficiary out here. So number of provisions, to my mind, which can benefit mutual fund industry as a whole indirectly, though nothing directly and substantially have come through.
While indirectly, of course, it will impact or be positive for mutual fund industry, Mohit, there is, of course, this fresh sweetener which has come in for new tax regime and it being announced as the default regime. Do you think while the other side of the mutual fund industry tends to benefit indirectly, it will have an impact on ELSS funds? Will they fall out of favor now?
Oh, totally, Sonal. I think, look, anyone opting for new tax regime for that particular individual, I think ELSS doesn't make sense anymore. ELSS has been one of the largest categories under the equity mutual fund segment, almost totaling to 1.4 lakh crores, roughly around 13% of equity AUM of the industry. So that will mean a massive blow to the industry. But my sense is the money will find favor in other categories, which are other than ELSS and of the same nature, like your diversified funds, more in the segments of flexi-cap or multi-cap or focused funds. I think perhaps the money will start moving out there, but ELSS surely will lose a large amount of their sheen.
And Mohit, this makes up around 13%, right, of the industry AUM?
Yes,
okay,
yes,
so
almost 1.4 lakh crores. Yeah.
Yeah, okay, so that is on ELSS funds. Money might probably move out. There are also some more disadvantages, right, of an ELSS fund, such as the lock-in. Do you want to run us through some of those as well?
Oh yeah, Pavitra, look, I think lock-in is of course there, which everyone knows. But to my mind, the biggest disadvantage of investing in a ELSS scheme is that you don't get to choose the style of investing. Look, if you and I are investing today in a mutual fund, we have full liberty and right to opt for a large cap scheme, a mid cap scheme, a value theme, a growth oriented theme, or a small cap fund. We can very easily make out. SEBI has done these classifications and categorizations, and it's very easy to select a theme of our liking as per our financial goals. But when you go for an ELSS, it is completely in the hands of the fund manager how he wants to run, and the nature of the scheme cannot be determined by you, basically. So the fund manager can run it like a mid cap or a multi cap or a flexi cap scheme or a large cap heavy kind of a scheme, and you can do nothing about it. And obviously there is a 3-year lock-in, which is though lowest amongst the tax saving instruments available out there, but still it's a lock-in. Plus, the biggest disadvantage also is that the returns are not tax-free, unlike other tax-saving instruments like your PF and the PPFs.
Okay, so those are the disadvantages, but we have to, of course, keep in mind that old regime is still applicable. There are a lot who will be benefited if they go ahead and, take up the old regime. So let's talk about ELSS investments in that case. If someone is going ahead and taking up old scheme, they are either done in a lump sum fashion or SIP. Do you think that really matters because the money is anyway locked in for 3 years?
Oh, it does, Sonal. Actually, I think while investing, it might sound quite simple that you're investing in an SIP format or a lump sum format, and both look equally good. And for a salaried individual, often the choice is an SIP kind of a format. But while redeeming or coming out of the schemes, you will have to be cognizant that every tranche will have to complete 3 years to be deemed as long-term in nature, or to come out of the exit load window, basically, or to be open up for redemptions, right? So the computations for taxation and the computations for redemption are a bit tedious. if you're doing an SIP kind of investment. To my mind, if your finances so permit, I think a lump sum is a better approach to invest in an ELSS fund.
Okay, a lump sum, method could be better. Mohit, since we were talking about the lock-in, a lot of ELSS money just gets churned in these 3-year cycles, right? Do you think that if you are investing in an ELSS scheme, that is a good way to go about it? Or should you just treat it as a long-term mutual fund investment and, you don't have to worry too much about that 3-year period?
Oh, absolutely, Pavitra. I think great point being raised out there. Honestly, in my humble experience, I've seen almost 7 out of 10 ELSS investors kind of try and churn the same pot of money after 3 years. So they will redeem from the existing ELSS and put the same amount of money in a new ELSS to get that ATC benefit. I think that's a very, very bizarre way, honestly. And to my mind, it's not the right way of investing. You have to treat ELSS funds like any other mutual funds or any other equity investments and give them long time frame. Performance of almost all the ELSS funds over a long time frame of 5 to 10 years has been absolutely remarkable, to be very honest. One, it's because of the long-term nature of these schemes, and also because there is a significant component of mid and small caps in these schemes. So if you allow the investments to flourish and hold it, if unless you need liquidity or unless you have a financial goal which has to be met, otherwise I think investors should hold on to the schemes and hold on to the corpus like any other mutual fund.
Okay. Mohit, while we are talking about government, talking about new tax regime, SEBI has been talking about the focus on passively managed funds, because they recently wrote to AMFI as well, allowing mutual funds having existing actively managed open-ended ELSS schemes to launch passive funds as well. And this can be done after stopping fresh inflows of subscriptions to the existing actively open-ended ELSS schemes. What are your thoughts on this one? And is this something that the industry really wanted?
Oh, I think it's a fantastic move. It's a fantastic move, Sonal. Honestly, passive is the ongoing trend. Passive is the face of new age investments industry. If you see globally, the trends are favoring passive investment as a style. US, the largest market of the world, is almost 52% passive now. Right, and India is moving into that direction. You have seen incrementally lesser and lesser active fund managers beating the benchmark and creating significant alpha. So to my mind, I think this is a watershed moment which SEBI has kind of ushered in. More investments will flow in. However, they have restricted the existing ones to offer passive investments till such time that they restrict the flows in the existing schemes, which to my mind is a bit of a dampener. Fund houses should have been allowed both the formats. So till date, we haven't seen many fund houses launching passive ELSS schemes. There's only one which to my mind has just come in as an NFO like a month back. But I see more and more industry people now offering in passive investments because of the cost. Also, one more point here, Sonal, if you kind of notice, the ELSS schemes have the highest cost structure amongst all other equity categories. The expense ratios are fairly high. So if you get in a passive format out there, you can check those expense ratios and actually significantly over deliver on the returns. So to my mind, it's a great move.
All right, a great move. And Mohit, on that note, we're going to wind down on this edition of Mutual Fund Corner. Thank you very much for taking us through, the kind of impact that we could see on ELSS funds if you do sort of look at the new tax regime, and also, how to really go about assessing if it is right for you. But on that note, we're going to wind down on this edition. Thank you very much for tuning in. From Sonal, me and the entire team, thanks for tuning in. And Closing Bell is up next.